this webinar on commodity options that Tradeplus is happy to co-host along with MCX. As we welcome you to this webinar, we want to thank you for joining us. And this is going to be a two-part webinar. Today being the first on commodity options, followed by an in-depth a higher level webinar, which will take place on the 16th of December. And we invite you for this, and we thank you for joining us today. Just a quick thing. Of course, you have already seen the video about Tradeplus. When you go to our website, you will be able to find details about our app, the Rocket app, and you can download it from there. There is also a WhatsApp chat available on the web itself, from where you can connect with us and chat with us at any point of time, 24/7. And of course, we being the pioneers of the flat plan, you can check out our pricing plans. We have two amazing plans. One called Smart Flat at 99 rupees per month, where you get about 30 trades, completely free of cost, and you can enjoy that. And if you're a budding trader, that's something that you must check out. And if you are a versatile pro trader, then we would encourage you to look at the 499 Flat Pro plan, where you can do unlimited trades across all segments. So that's just about it. All these details are available on our website. So would encourage you, if you're new to Tradeplus, you would like to probably take a look at that. We are going to dive straight into the webinar, and I will be introducing Mr. Srikanth in a while. But just a few, house rules for all of us to enjoy this webinar. Would encourage all of you to keep your mic muted, so that you can listen while Mr. Srikanth is going to be talking and teaching us about commodity options. I'm sure we want to be disturbed, and therefore we will not like to disturb anybody else. The second thing is, if you have a question, you are free to put it up in the chat. Okay, kindly put it up in the chat, so that we will take up that question at the end of the webinar. Okay, once Mr. Srikanth is through with his presentation and all that he has to say today, we will take up those questions and we will moderate it, and so that it's about a beneficial time for everybody. Also, kindly do not switch on your camera, because that will be a problem for you as well as for others. It could be a disturbance, and again, also it will be eat into the bandwidth. So for the general well-being of this webinar, would encourage all of us to abide by these rules, right? And of course, you can all ask questions, but we would like it to be limited to either commodity options, or if you have anything specific to ask about MCX, then we have the experts here and they'll be happy to address it. If you have any queries related to the product, then you can put it up in the chat, and our team would address it at the end of the webinar, or we would connect with you, and then we will solve your issues right there. So without much further ado, I would like to welcome Mr. Srikanth and Mr. Suraj, both the dignitaries from MCX. And we thank you both for taking this time and doing this webinar with us for our clients, and also for the many friends who are here with us. Mr. Srikanth is a fellow member of the Chartered Institute of Management Accounts, UK, and he has served more than 25 years across various diverse domains, especially in finance and capital markets, especially in the areas of audit, research, ERP, MIS, and corporate training. Currently, he is leading the training and education function at MCX, and therefore, he's the right person for the day. And Mr. Srikanth, we are so grateful to you. Thank you so much for doing this for us, and we really look forward to learning.
Thank you.
On behalf of all the participants, I welcome you and join with them. And I want to tell them we are all eager to learn from you. So over to you, Mr. Srikanth.
Thank you very much. Before I start, I just need to share my screen.
Okay. Mohinder, can you do that? Can you make Mr. Srikanth co-host? Yeah.
Yep, thank you. I can see that I'm. Someone should just tell me that you can see the screen. Okay. Is
Yes.
everybody?
Yes, sir. We can see the screen. Yeah.
And you can hear me also. Great.
Yes,
Wonderful.
absolutely. Absolutely.
So thank you very much for the kind introduction. And I have been told that this session should be in both Hindi and in English. So I'll do my best to do it in both the languages. Today's session is, we are talking about the basics of options, but it's very critical that you have a very strong foundation, because then only you'll be able to understand and appreciate the various strategies which can evolve around options trading. Some of them, you'll find that firms will, will give you some tips, or they'll give you some strategies, but you won't be able to appreciate it unless and until you have a strong foundation. So I'll start by just telling you where we are so that we are all on the same page. We are in the commodity markets, and commodity markets are very strongly interlinked with the currency, debt, and capital markets, meaning कि कुछ भी अगर होता है यूएस में, बिकॉज क्या है कि 85% ऑफ कमोडिटीज आर प्राइस्ड इन यूएस डॉलर्स, और एनी टाइम देयर इज चेंज इन इंटरेस्ट रेट्स इन अमेरिका, उसका इम्पैक्ट गिरता है रुपी डॉलर एक्सचेंज रेट पे. So that is one thing that you should understand. Just a moment, I think someone is, just give me a minute. Right, sorry about that. Yeah, okay. So what happens is, every time there's an exchange rate change, it has an impact on the price of commodities in rupee terms. And the real problem starts because you are buying in the future. So आपको वो भी देखना पड़ता है कि yeah, so you also have this other issue whereby there's some noise coming here. I'm not sure what that is. Okay. So इसमें क्या होता है कि जब कोई भी चेंज आता है इंटरेस्ट रेट्स में अमेरिका में, उसका इम्पैक्ट रुपी डॉलर पे गिरता है, और जो कमोडिटीज जो हमारे एक्सचेंज पे जो ट्रेड होते हैं, that is you're trading in rupees, so it has an impact on the price of commodities. Now when you're buying a derivative, you're buying something or selling something in the future, so you also need to have an idea of what can happen to the exchange rate in the coming days. Because suppose I'm buying a contract which is, say, February contract or a January contract, then I need to know between today and the date of the contract, because contract jo hota hai, you recognize it by the date of its expiry date. Between today and the expiry date, kya ho sakta hai to the exchange rate will have an impact on commodity price, and it will have an impact on what strike price you will be trading at. So strike price ke baad hum thodi der mein baat karenge. So interest rates underlying for a debt market, impacting currency market. Lot of money comes into India. A lot of money can also leave the Indian stock markets. If somebody finds a better destination for investment, you will find people will, especially FIIs and pension funds, they will move their money in and out of the Indian stock markets. So whenever that happens, you will find Sensex or Nifty, there's a big impact on the capital markets, and you can note that, you can see that by observing the Nifty or the Sensex index. Now, whenever there is this movement of money in and out of the country through the capital markets, uska impact currency markets pe girta hai. That is, money coming in, rupee becomes stronger. Money leaving the Indian shore, the rupee become weaker. Automatically, it has a commodity markets impact. So I'm just leaving you with this, but I want you to always be very clear in your mind that some of you might be trading in the capital market, but you must know that all the markets are interlinked, और उसका impact subject पे आता है. Okay. Now I go to the next slide here. Right, this is my favorite slide. I've been using it for many years, but this is to make sure that everybody's on the same page. So what is traded on a commodity exchange? We do not trade commodities. I want you to be very clear on that. Commodity exchange एक्सचेंज पे हम कमोडिटीज ट्रेड नहीं करते हैं, हम कमोडिटी कॉन्ट्रैक्ट्स ट्रेड करते हैं। और कॉन्ट्रैक्ट्स कौन से वाले? फ्यूचर्स एंड ऑप्शंस वाले। सो कमोडिटी फ्यूचर्स, कमोडिटी ऑप्शंस, दीज आर द टू इंस्ट्रूमेंट्स व्हिच आर ट्रेडेड। तो हर इंस्ट्रूमेंट के पीछे एक अंडरलाइंग रहता है, मतलब एक गोल्ड फ्यूचर्स हो गया, गोल्ड ऑप्शंस हो गया, या यू माइट हैव सिल्वर फ्यूचर्स, सिल्वर ऑप्शंस, और crude oil futures, crude oil options. So the point here is कि instrument तो futures हो सकता है, options हो सकता है, but underlying contract depends on the whatever contract you're selecting, the commodity that you're selecting. However, what you're trading is a commodity contract. Why do you have these? Why do you require commodity contracts? हम इसको बोलते हैं pillars of commodity exchange. One is price discovery and managing risk. Now जब ये जो those who are managing the price risk by hedging, for them to take a position, investors play a very critical and important role. They bring liquidity to the market, whereby anyone taking a position in a commodity derivative contract, someone willing to take the position, someone should be there on the opposite side to take on the risk. And that important role is played by investors who are there for a different duration of time. When I'm talking about duration of time, it means all these contracts, you can enter the contract or you can exit the contract during the trading hours at will. That is the beauty of a derivative एक्सचेंज ट्रेडेड डेरिवेटिव मार्केट। आपने एक बार कॉन्ट्रैक्ट खरीद लिया या बेच लिया तो आप उसको कॉन्ट्रैक्ट को आप जब चाहिए तब एक्सचेंज के वर्किंग आवर्स में आप उसको रिवर्स कर सकते हैं या आप आपका पोजीशन स्क्वायर अप कर सकते हैं। सो अभी हम वी कम टू द ऑप्शंस। सो ऑप्शंस जो है इट गिव्स अ बायर अ राइट। नाउ आप जब ऑप्शंस की बात करते हैं हम, इट इज अबाउट अ राइट टू डू समथिंग। या तो अगर इफ आई बाय अ राइट टू बाय तो हम उसको कॉल ऑप्शन बोलते हैं। इफ आई हैव अ राइट टू सेल तो मैंने आई इज कॉल्ड अ पुट ऑप्शन। बट ये जो राइट जो मैं खरीदता हूं या मैं बेचता हूं, टू बाय दिस राइट आई नीड टू पे मनी। सो एनीवन हु बाइज अ राइट टू बाय और राइट टू सेल, the minute you buy a right, you need to pay a little bit of money. That money is called premium. So आपको premium जो आप देते हैं, you're paying a premium to buy a right to buy, call option, right to sell, put option. Now, every time I'm buying a right to buy, then someone should be there on the opposite side who is willing to lock on to that particular contract. So he will take your premium and he will tag on to that contract. So the minute you buy a right, you're called the buyer of an option. Sorry for the spelling there. Okay. But the minute you are trying to buy, you're buying a right to buy. So you have paid money. That money goes to the opposite party, which is known as the seller of a call option. So when I have a right to buy, I'm a buyer of a call option. The opposite party becomes the seller of a call option who takes this premium. Now, a couple of things here. One is that when I buy a right, I have the right to buy, but I have no obligation to buy. And the person who takes the premium, he will be obligated to sell. But in other words, he is locked into that particular contract and he's obligated at the time of expiry of the contract. Yeah, so that is as far as a call option is concerned. For a put option, the buyer of a put option pays money. Now he buys the right to sell. So put option buyer buys the right to sell. So minute he has a right to sell, the person who receives the premium, he will be obligated to buy. So it is basically options. Itne complicated nahi hai. If those of you who are new to the market, it's only 4 situations that you have to come to handle: buyer of call option, seller of call option, buyer of a put option, seller of a put option. तो इसमें जो terms जो use करते हैं, एक तो होता है premium. ये premium जो होता है, that is the amount you pay to buy the right. And of course, it is also the amount of money that the writer is expecting to receive for getting obligated towards the contract. Now, there is something called a strike price. Now, for example, I pay you 10 rupees now, and I buy the right to buy something from you, a commodity from you, at 500 rupees a kilogram after 3 months. Yeah, so I have paid you 10 rupees to buy the right to buy something from you 3 months from now at 500 rupees. Now, the 500 rupees, that is called the strike price. So I've agreed to buy at 500 rupees in the future, 3 months ahead, but to buy that right, I've paid you 10 rupees, which is called a premium. We'll have to go over these again in some of the slides, but at the moment, the kind of options contracts we have here in India, we have the European options contract, which means that the contract is settled only at expiry. The European contracts are settled only at expiry. We do not have American options contract. So basically, इसको हम बोलते हैं style of option. ये जो style है, ये European style है. These contracts are settled only at expiry, whereas the American options can be settled anytime during the life of a contract. However, when I say settle, it doesn't stop you from squaring up your position at the same strike price. Yeah? So आप square up तो कर ही सकते हैं at the same strike price. ये moneyness जो है, in the money, at the money, out of the money, इसका मेरा पूरा detailed slide आने वाला है. So I'll explain that when I come to the slide. Now, there's something called an intrinsic value, which is basically if I buy a right to buy something from you 3 months ahead at 500 rupees. But today, the price in the market is 1,000 rupees. Yeah, I have a right to buy at 500. Market price today is 1,000. So at this moment, I'm sitting on a profit of 500 rupees again, because I have bought a right to buy at 500. आज के दिन market value चल रहा है 1,000 rupees. तो मैं 500 रुपए प्रॉफिट में हूं. वो जो 500 रुपए जो प्रॉफिट में है उसको इंट्रिंसिक वैल्यू कहते हैं. So that is known as intrinsic value. We look at intrinsic value detail when we're looking at moneyness. ये black 76 मॉडल जो है, ये जैसे स्टॉक मार्केट में people who use algo traders who use software, they also use something called the Black-Scholes model. So Black-Scholes model is popularly used for algo trading or machine trading in the stock market. But when you talk about the commodity market, you have to adjust that particular software, and you have to make adjustments to the formulas which make up the Black 76 model, and that make up the Black-Scholes model. And now you come up with something called a Black 76 model. So Black 76 model is what is used in the commodity options trade. Yeah, but in commodity markets, we are using Black 76 model. In the stock market, you use Black-Scholes model. Yeah, so but don't worry too much about it, but keep that as a knowledge base. But we won't get into that much detail, neither in this session nor in the next session. And this moment, all you need to know is that there are some models which can be used to find out how much premium I should offer, or how much premium I should expect to get if I trade at a particular strike price. So this is just it just gives you an idea of how to trade, or you can attach it to your computer screens and the machine takes over. Yeah, so that is the other option that you have. Now, so here whatever I've said so far is just repeating the same thing here. So a call option. So a call option gives the right buyer the right, but not the obligation, to buy specific quantity of an underlying asset at a set price on or before a specific date. So ये जो है ये definition है. So the call option buyer, he buys the right, but he has no obligation towards the contract. Whereas the writer, he receives the money, the premium. The writer, however, has the obligation to sell the underlying asset, but you can see that if is in red if the buyer decides to exercise his option to buy. Okay, and we will see the conditions in which that if comes into play. But generally speaking, the call option buyer, he has a right, and the person who takes the premium, he is obligated to sell only if the buyer of a call option decides to exercise his right. Now, like I said, there's another position here. Okay? Another position here. Let me just get back into chat because there are a lot of messages in this chat. Screen not visible. Are we okay now? Are we still having a problem with the screen? Yeah.
No, Mr. Srikanth, it is visible. I think maybe there's an internet issue for Mr. Srinivas.
Okay.
But we are all able to see the screen.
Sure. Okay. Right. Thank you. Okay. So this call, when we're talking the put option at the bottom half of the screen, the put option gives the buyer the right, but not the obligation to sell. So for example, a farmer, he can actually say that I'll pay you some money now and I buy the right to sell 10 tons of a produce 3 months down the line. So I'm locked into a selling price. So this is like a risk management for the farmer. But the person who accepts that premium, he is obligated to buy the underlying asset. But only if the buyer of a put option decides to exercise his option to sell. So basically what is happening is the buyer buys a right, the seller gets the money, and he is now obligated towards that contract. So that is the definition. So I just want to tell those of you who are new to options, this page is very important because if you have understood these 4 situations, buyer of an option, seller of a call option, and a buyer of a call option, buyer of a put option, seller of a put option. If you understand these 4 situations, everything's it emanates from this. Everything starts from here. So you won't have a problem. So what are our options? It's like an insurance. I pay you a little bit of money and I buy a right to buy or I buy a right to sell. So it doesn't matter which direction the price is moving. So I am locked into a price. So this is like almost like insurance. So maximum loss is to the extent of the premium paid, because the buyer of a call, buyer of a put who has paid the money, he has no obligation towards the contract. He can walk away from the contract, and the maximum loss he will suffer is the premium he pays to the buyer. So maximum loss is easy to determine and easy to put in your books and easy to account for it. So becomes for the buyer of a call and a buyer of a put, it is a very straightforward financial transaction that he can look at because he can lock into that price. The writer, as far as the writer is concerned, who may be obligated if the price moves against him, in such situations, for him, the risk is far more. His risk is very high. Now, exchange traded options, their options are free from counterparty risk. So what is counterparty risk? So when I'm trading, there's always a buyer and a seller. If I trade in an OTC market being where 2 people negotiate a trade face to face. So I agree to buy, you agree to sell to me. We agree to sell and buy at a pre-agreed price for which I pay you a little bit of money now. You may call it a premium, and we lock into the price, into that trade at the pre-agreed price. But 3 months down the line or 4 months down the line, any one of the parties can walk away from the contract. He'll say, I don't want to go ahead with this contract. So the counterparty risk here is very high in an OTC options contract. So यहाँ पे क्या होता है? यहाँ पे in the options contract of an exchange trade, here the counterparty risk does not exist because the exchange comes in the middle. So when you're trading, you don't know who the other party is. Both the parties to the contract, the buyer and the seller, they don't know each other. They are just trading on a screen or they are trading on a mobile and they don't see the other party. So whom are you trading against? So you're trading against the exchange actually. So that whole concept is called novation, where exchange is the buyer to every seller and the exchange is the seller to every buyer. So exchange traded options are free from counterparty risk. So if any party defaults, exchange steps in and makes good that contract. In other words, what we are saying is that you don't have to worry if you're trading on an exchange. If you trade outside the exchange, there's always that risk that the counterparty might just walk away from the deal if it does not suit him. Now, options are risk management tools which give leverage of futures with safety of options. So this is what we say, that you have both the facilities. It gives you leverage of the futures because you pay a small amount of money to take a position, and safety of options is that you know how much money you will eventually trade at, so you are locked into the strike price. So profits from change in price, but limited losses via options. So there's limited option losses here. Participants can devise hundreds of effective strategies. So जो ट्रेड करते हैं ऑप्शंस में, उनके पास ऐसा नहीं है कि भाई मैं बहुत साल से ऑप्शंस में ट्रेड कर रहा हूं, so I'm I have a better handle. It's not that. Anyone can come up with new strategies. So it is a nice thing if somebody is very innovative. Someone he wants to broaden the scope. He can think out of the box, come up with different strategies. So you can come out with hundreds of different strategies. Whatever strategies you have for trading, that strategy might work today, might work tomorrow, but not necessarily it'll work all the time, because you need to keep devising new changes to the existing strategy based on the changes that you're observing in the market. So as things are changing, as things are evolving in the market, your strategies can also evolve and change. So it gives you a lot of flexibility there, and it gives you a lot of those who trade options, they feel some sort of you might call it a high. So they say, I can conquer a particular position, I can think out of the box, I can come out with new strategies. So it is a very nice thing to do. All you need to do is you think of all the different positions that can happen based on price movements, and then we will look at this particular part in the next session when we do. We'll look at some couple of strategies at that point, and you will understand what I mean by this particular point. So you can do better cash flow management, one-time payment of premiums, so you know exactly how much money has been given away, and how much you can walk away from it, so you know exactly how much money you're gonna lose. And if the price moves in your favor, then you know that it's only one-way traffic, you're making profits. I'm talking from the buyer's point of view. The sell writer, he of course looks at it from a different viewpoint. Writer looks at a position, and he thinks that kind of a position may not occur, that the price might not move in the direction in which the buyer of an option is anticipating, and hence he is happy to trade. He's happy to trade by accepting the premium, because he thinks that the call options buyer, his view is not what the put options or the call options writer has got in mind. So the option buyers and option sellers, they have different views of the market. So options buyer, he pays a premium, buys, and he has got a right to buy. A put options buyer, he pays a premium, the right to sell. So this is basically, we're just putting it in a short kind of a box here. Options seller, he collects the premium, he's obligated to sell. And a put option, the option seller collects the premium, he's got an obligation to buy. So these are the four situations we're looking at. When you trade on a commodity option on a exchange trading terminal, for example, you'll get many strike prices. So you got different strike prices. You can choose the various strike prices. So let's assume that I want to trade at, say, 50,800 down here, right? So I can pay you 100 rupees now, and I buy the right to buy gold at 50,800 in 3 months' time. And the other party on the other side says, whatever amount you're paying is too less, you'll have to pay me more. And then we can get into that agreement to buy and sell at 50,800. Or you can, at 50,800, if I want, I can be a put options buyer. I'll pay you money to buy the right to sell at 50,800 after 3 months. And the person who accepts this money, he'll be obligated to buy. Yeah, that's in a put option. Now, this 4 situations that I described at 50,000, it happens at on all the different strike prices. Sometimes you'll find that no trades are taking place on some of the strike prices. That's because these strike prices are maybe too far out of the money. We look at that out of the money concept also, but I just want you to know that we can have it that way. Somebody's asked a question. options are liquid in which all commodity segments. So basically, gold is the and silver, very liquid, and so is crude oil. So these are the ones which are quite active. Okay. Now the question here someone has asked is, which is better, weather commodity options or index options? Well, when it comes to weather commodity options, in India, we don't have weather commodity options. They're there abroad. Weather commodity options are there on the Chicago Climatic Exchange or the European Climatic Exchange, Japanese Climatic Exchange, or what we call Tokyo Climatic Exchange. That's where you find the weather commodity options, but we don't have them in India. But index options, we don't have them here either as of now, but we are considering launching of index options in the near future. Yeah, so I'll take care of that question now. Okay. So the kinds of options we have, I think I mentioned earlier, we have European options. Buyer of an option can choose to exercise the option only on the date of expiry of the futures contract. Yeah, in American options, you can exercise it any time, and hence, but unfortunately, we don't have American options. We have only European options. Depending on the style of options, you can have so many more different strategies which can evolve, because different styles of options open up for new different types of strategies. So I'm going to the very basic. I'm taking one particular example here. This is a buy call option. So let's look at this. It says the view is bullish. Buy a 1 month call of aluminium. Don't worry about the prices. The prices might be too low at the moment, but the logic is what you need to understand. With a strike price of 105, pays a premium of 5. This strike price of 105 is, if I go back again, like these are the strike prices. Yeah, you can see so many different strike prices. So somebody is trading at a strike price of 105. He's picked up 105 as a strike price, and he says, I'll pay you premium of 5. And I want to buy the right to buy at 105 after 1 month. Now, the couple of things that come out of this particular slide here. One is, the first thing is view. Now, this view is bullish. Bullish means this person he thinks that the price is going to go up. Okay, and so he's willing to pay you 5 rupees after now, so that after 1 month he can buy at he is basically locking into the price of 105 per kilogram. Yeah. Now, view doesn't mean much. It just means, like, we ask each other, what do you think? What do you feel? Do you think the price will go up? What do you feel? Do you think the price will go down? This is called a view. Whenever you read or you watch television to find out some of the commentators who come on the business channels and tell you about stocks moving this way or that way, basically they're giving their view. And hence, if you have a bullish view, it means that you're anticipating prices to go up. Now, here in this particular question here, what is really happening is that this gentleman, he probably has a need for aluminium, and he needs the aluminium after 1 month. Okay, but he's bullish about the price. He thinks the price of aluminium is going up. So he wants to lock into the price, and hence he's willing to pay you 5 rupees now and lock into the price of 105. So that is what this particular slide will tell you. Now, if I go to look at what could happen after 1 month. So after 1 month, what might happen? So after 1 month, the price could be 120 or it could be 100. So I have no idea which direction the price is going, right? So if the price is 120, I have a right to buy at 105. So it's good for me. So I will exercise my right. So I, as a buyer of a call option, I exercise my right to buy at 105. I have that right because I paid the 5 rupee premium. So I paid the 5 rupee premium. I exercised the right at 105. So my total cost is 110. And the market price is 120. So in other words, if this gentleman were to buy the premium, the aluminium in the open market, it would cost him 120. And hence he makes a profit of 10. However, if the price drops to 100, if the price in the open market, if the market price is 100, then why would somebody pay 105 and buy aluminium? He'll just walk away from the deal because he has no obligation. He only has a right, but no obligation. So if the price drops to 100, he walks away from the deal and he buys the aluminium in the local market at 100. In such a situation, if the price was 100, his cost would be 5 rupees, and hence his total net payoff here is 5. So at various different prices, whatever the payoffs are, the last line there, whatever the payoffs are at different prices, you can put it in a graphical presentation, and it would look like something like this. If I were to interpret this, what it basically says is that if the price goes beyond 110, the higher it goes, the more money I make. Like in this example, yeah, when the price is 120, he makes a profit of 10. So if I see that if the price goes up to 120, then if you draw a perpendicular line there and a horizontal line here, you come to 10, right? So it's basically, it's just, you can make that in this particular format. Okay, so this is a graphical presentation of that particular situation. If the price drops less than 110, then he will not exercise his right, because if he exercises his right, why will he? He can buy cheaper in the market. If he were to exercise, he would have had to pay 105. So he will not exercise his right, and he will suffer a loss of 5, and he'll walk away from the deal. There's a little gray area here. Yeah, you can see that little triangle there. If the price was, say, 107, if the price was 107, he would still exercise his right, because he could reduce his loss from 105 to perhaps 103. Sorry, from -5 to -3. Yeah, so here there's an area here where even though you're making a loss, you will still exercise your right, but you will actually reduce your loss from -5 to whatever that position, depending on where the price halts. So this is the buyer of a call option. Similarly, while the buyer of a call option has paid 5 rupees to buy the right to buy at 105, you also have the seller of a call option who has accepted the 5 rupees. He has accepted the 5 rupees premium with a strike price of 105 after 1 month. And obviously, if the buyer is bullish, the view of the seller is bearish. He thinks the seller of a call option thinks that the price will fall, and hence he enters the contract. He thinks the price will fall. In other words, he's bearish about the market. So if you look at the situation here, what would really happen is he's expecting prices to fall. He has accepted the 5 rupees premium, and by the way, the maximum profit that he would ever make is the premium. The seller of an option, the maximum profit he makes is the premium that he receives. Now, and he has done so because he thinks the price will fall. He thinks the price will fall so much that the buyer of a call option will not come back and exercise his right. However, if the price goes up, then he makes a loss. In fact, this is called a mirror image. So if you look at this particular chart, when I showed you earlier, this is the buyer of a call option. And if you just reverse this particular chart, and you get exactly a mirror image of that. Here's making a profit of 5, but if the price goes up, he makes unlimited loss. Yeah, so it is exactly the reverse of that. Now, if we go to the third situation, remember there are only 4 situations to overcome. Now we are already on the third situation, buyer of a put option. So what does a buyer of a put option do? He buys the right to sell. Now, why is he buying the right to sell? Because he thinks prices will fall. It's like example I gave you was a farmer. A farmer has worked in the sun, he's toiled, he has harvested his crop, and he thinks that after 1 month, when I go to sell, the price might drop and I might end up making a loss. So today he can go into or come to a commodity exchange, and he will buy the right to sell. He can do so by buying a put option. And he's doing it because he's bearish. He feels that the price might fall. He's anticipating prices to fall. So he wants to lock into the selling price. So he pays 5 rupees and he buys the right to sell at 30 rupees per kilogram. Right? So now what can happen after 1 month? After 1 month, the price could be 40 or it could be 18. He has a right to sell. Now, if the market price is 40, he will not exercise his right, because he will get a better price, which is 40 per kilogram in the open market. And he will be satisfied making the loss of 5 rupees premium that he's paid. Okay. However, if the price were to drop, right, to 18, if the price was to drop to 18, that means if the farmer was to sell in the open market at 18, he's going to get very less. But remember, he's gotten into he's bought a put option. He has a right to sell at 30. So he will exercise his right and sell at 30. The opposite party will be forced, is obligated to buy at 30. So how much money do you make? 30 minus 18 minus the premium that you've paid gives you 7. Okay, so that is how you find out how, whether you are in a positive position or negative position. So the maximum loss you would make is the premium, and the profit you make would depend on how far down the price will go. Now, this information, the first line here and the last line here, if I put it in a graphical presentation, it will look like this. If the price drops, if the price goes down, it's profit potential. If the price goes up, then the farmer will be happy to sell in the open market, forfeiting the 5 rupees that he has paid upfront by way of a premium. Yeah. So if the price, so basically what has the farmer done? He's locked into the price at 30. So he's assured of 30 or more. If the price drops, he gets 30. If the price goes more, he sells it in the open market at a higher price, at a cost. And the cost was 5 rupees. Okay. So the third situation, this is a buyer of a put option. The fourth situation is a seller of a put option. The seller of a put option is bearish. I think this, so that should be the seller of a put option. What has he done? He is bearish. Yeah, so it is exactly opposite to this particular situation. He's anticipating prices to fall, and hence he has received the premium of 5 at the strike price of 30. So he sells 1 month put contract. He's doing it because he thinks the price will fall. He thinks the price will, sorry, actually there's an error here. He should be bullish here. He should be bullish there. Yeah. Okay. We'll change that. What normally happens, he's expecting prices to go up. He expects prices to go up so much that he thinks the buyer of a put option will not exercise his right. Yeah. So that is how we look at it from that point of view. So here's a graphical presentation of a seller of a put option where he has received the 5 rupees premium, and he has gotten into this position because he thinks the price will go up, and the buyer of a put option, a right to sell, he will not come to you because the price will go up. But of course, the buyer of a put option will come only if the price drops. Yeah? So he'll only come and exercise his right if the price drops. Okay. So these are the 4 situations. When you come to options, you have to understand only these 4 situations. We got one more chance to get through all this in the slides which are coming. But there's some terms which are unique to options trading. One is in the money for a call option. That is when the future contract's value is above the strike price. In the money for a put option, where the future contract value is below the strike price. And we have at the money, futures contract value is equal to the strike price. We got out of the money call options. Now, don't worry too much about this because I'm going to do this with numbers in a few minutes. Yeah. And open interest is a total number of options contracts outstanding or open in the market at any given point in time. So I'm going to touch upon these with some examples. So it becomes much more easier to understand what we're talking about. So let's take the first one, in the money. Yeah. And out of the money. Call option buyer. We're looking at the call option buyer here. Yeah. So underlying futures. Now, underlying for options contracts in India, the options contracts that we have, they're called options on futures. So underlying is a future, or you can even say it's a market price. So contract values above the below price. So let's look at this statement here. Let's look at the statement here and let's decipher this statement. On 15th of July, Mr. Z, he buys a call option. Now, remember, he buys a call option. In other words, he's paying a premium. Yeah, because the minute you buy a right, you pay a premium. He's paid a premium of 200. He buys on 15th of July, he buys a call option on a 31st December contract, strike price 45,000. So at a strike price of 45,000, he has paid 200 and he's bought the right to buy at 45,000 rupees when on 31st of December. So this is how I decipher this particular piece of information, this one line. He's entered the contract on 15th of July. The contract is going to end on the 31st of December. and there are many strike prices to trade on. He chooses 45,000. He says, I want to buy the right to buy at 45,000. For that, I pay 200 rupees premium. Now, what can happen? On 31st of August, that means just about 1.5 months after he entered the contract, on 31st of August, the underlying price is 50. Underlying price meaning it's either the market price or the futures price. Yeah. So underlying price is 50,000. He has a right to buy at 45,000. The market price or the underlying price is already 50,000. So is he happy or not? Yes, he is happy. How happy is he? He's 5,000 rupees happy. Okay. He has a right to buy at 45,000 on 31st of December. But on 31st of August, it already is 50,000. So as on this date, 31st August, yeah, this is a very important critical piece of information. As on 31st of August, he is happy. He is 5,000 rupees in the money. And that 5,000 rupees in the money, the 5,000 rupees, the money value is called intrinsic value. So if I go back again, in the money for a call option, future contract value is above the strike price. Yeah. So the future contract value is above the strike price. Okay. So that is how we interpret that. Now let's see what happens. The contract is of course going to end on 31st of December. He entered the contract on 15th of July, but on the 10th of October, the underlying price is 42,000 rupees. He has a right to buy at 45. The price remember, when he traded at 45,000 strike price, after that, the price has gone up. The underlying price, meaning the market price, has gone up and now it has come down. So it has come down to 42,000. Now he has a right to buy at 45,000. So is he happy or not? Well, is he in the money or out of the money? Well, he has right to buy at 45. In the market is available for 42. Obviously, he's not going to exercise. So he's 3,000 rupees out of the money in such a situation. Okay, so this is how you look at the situation whether somebody is in the money or out of the money. You're comparing the market price or the underlying price. Why I keep saying underlying price is because the options contracts on commodity exchanges in India, they are all called options on futures, and hence the underlying price is the futures price. So let's look at the second situation. In the money, out of the money for an options call writer. Now, let me decipher this again, just like we did earlier. On 15th of July, Mr. Y sells a call option on the 31st December contract. So the contract is expiring on, expiry date of the contract is 31st December. He sells a call option, strike price 45,000 rupees by receiving 200. So because he sells, yeah, Mr. Y sells, so hence he's receiving the premium. Now also remember, the premium comes into his account at T+1. So if he has traded on the 15th of July, then the money comes into his account on the 16th of July, yeah, T+1. Okay, so that 200 rupees comes into his account. So that premium comes into his account. Okay, now he has he's a writer. He's a options call writer. So he's basically sold the options contract. In other words, he's paid the money, and he may be obligated. He may be obligated to sell at 45,000 rupees. Remember this. He may be obligated to sell at 45,000 rupees. So on 31st of August, the underlying price is 50. So will he be obligated to sell? Yeah, of course he will be, because the buyer, if he goes to the market, he gets it at 50. Whereas here in this deal, he's already agreed to trade at 45,000. So he will exercise his right at 45,000 rupees on the 31st of August. So he's in the money. How much in the money is he? He's 5,000 rupees in the money, because market price is 50,000. Yeah. And this guy, now who is in the money? The call options buyer in the money. Yeah. So this particular gentleman, the call writer, he's out of the money. Yeah. Because the buyer of a call option who is in the money will exercise his right, and he'll get it at 45, whereas the market price is 50. So the call option writer will be obligated. Yeah, it will be obligated and hence he will be out of the money. Okay, so this is how we look at this particular position. Let's look at the second one. What happens when the market price becomes on the 10th of October? On 10th of October, the underlying price is 42,000 rupees. Okay, now let's go back again and let's do this again. So on the 15th of July, he contracts. So he's received 200. And he may be obligated to sell at 45,000. So will somebody obligate him to sell at 45,000 rupees when it's available in the market for 42? The answer is no. So in this case, he's in the money. Yeah, he's in the money 3,000 rupees. It's because the gentleman who entered the contract from the buy option side, he will not exercise his right. And hence, because the market price has gone to 42, the buyer of a call option will be happy to buy in the open market at 42,000 rupees. And hence the writer of a call option will be sitting pretty at the intrinsic value of 3,000 rupees profit. So let's look at the third situation. In the third situation, that's in the money or out of money for a buyer of a put option. Now we're looking at a put option here. So in a put option situation here, let's again decipher this particular line. On 15th of July, Mr. AZ buys a put option on a 31st December contract at 30,000 rupees by paying 150. Okay, so he has entered a contract, which is a December contract. Strike price 30,000 rupees. He's paid a premium of 150. By paying the premium, he's got a right. He's got a right to sell at 30,000 rupees. Okay, now by 5th of December. Now, remember, the contract is running to 31st of December. By 5th of December, the underlying price is 20,000 rupees. Now, he has a right to sell at 30,000. If he sells in the market, he only gets 20. So he will exercise his right to sell. If he exercises his right to sell at 30, so he makes a profit of 10,000 rupees. So he's in the money 10,000 rupees. Yeah, so he's in the money. And what is the intrinsic value? 10,000 rupees. But by the time, well, there's only one situation here. I've not got another situation, but let's assume by 31st of December, suppose I had another one on 31st of December. If the price had moved, become 40,000 rupees, then he would have been out of the money. Okay, so you have to compare, like we go back again to where I was looking at earlier. So whether you're in the money or you're in the money, the position that I'm looking at just now was out of the money for a put option with the future contract values above the strike price. Okay, there's one more position. I buy a right to buy at 45,000 and the price in the open market is also 45,000. So basically I'm at the money. So it's equal. The strike price equals the underlying price. We are at the money. So you have these situations where you look at the price, the strike price at which you have traded, and you compare it with the price prevailing. You compare the two and see whether you're in the money or out of the money, depending on whether you're a buyer or a seller of an options contract. Again, there's a bifurcation here. You're looking at, am I a buyer of a call options contract or am I the buyer of a put options contract? So, and similarly, you have to do exactly the same thing if you're a writer of a call option or a writer of a put option. Okay, now, those of you who are familiar with futures, and if I have to explain what options are, futures are exchange traded. Options, they are exchange traded and also OTC products. In other words, two people can sit across the table and design an options contract. Futures, you pay margins. In options, you pay premiums. However, the writer of an options contract, he has obligation towards the margin money. Yeah, because the buyer has paid a premium, the writer has to bring in the margin money. But one thing I must tell you about margin money is that whenever someone squares up the position or when the contract comes to an end, the margin money is refunded back to the trader. So margin money is just to lock you into the contract that you've agreed to enter. Whenever you square up a position, margin monies are returned. Premiums, on the other hand, once paid, you never get it back. So that's the one big difference between the futures and options. Now, future prices, they reflect the holding costs and market perception. So if I say that the price of gold is going to be, let us say, 53,000 rupees in February, right? So what does that 53,000 mean? It means what is the spot price today, plus how much would it cost me to buy the gold today and keep it till February? Yeah. So what is that holding cost? Plus or minus a perception of what could happen in the international markets or in the currency market or demand supply or in any of the other factors which impact that particular commodity. In this example I gave you is gold. So I'll have my perceptions of that. So future price, whatever price I punch to buy a contract in the future, is a reflection of the current spot price plus the holding cost plus or minus a perception. Whereas when we play in or trade in options, it is the premium that I pay that is a reflection of the holding cost plus the market perception. The premium will go up and down. So in other words, if I wish to trade at the same strike price, but if there are some changes in the market, then those changes will be factored into the premium. I may have to offer a higher premium or a lower premium if I wish to trade at the same strike price. This change in the premium has occurred because I wish to trade at the same strike price, and the changes which have occurred will get absorbed in the premium that I'm offering or I'm expecting to receive. Now, in the futures, we can square up our positions. Yeah, so anybody can square up his position. In options, the buyer has no obligation. The buyer, he has got a right to buy at a particular price for which he has paid a premium. So he has no obligation. Whereas the writer is obligated. He can actually square up his position there if he wants by taking an opposite position in the market, yeah, at the same strike price. So what affects futures prices? What affects options prices? Now, do remember one thing: whether it's futures or options, both these are instruments. Yeah, these are derivative instruments. So what affects the price is the underlying, whatever the commodity that you're looking at, whatever is going to impact the price of the commodity will have an impact on the instrument, whether it be it futures or be it options. Okay, so what are premiums influenced by? So they're influenced by the underlying futures contract. In other words, whatever is happening to the price of the commodity, underlying commodity, the gold prices, for example, or crude oil prices, silver prices, whatever is happening in the market to the spot prices will have an impact. Yeah, so price changes in the underlying futures contract will have an impact on how much money you're going to offer by way of a premium, or how much money you're willing to accept by way of a premium, depending on the changes that are taking place in the market. So strike price, we have in the money, at the money, out of the money. So they will all have an impact. So if you're in the money, you end up paying a higher premium. If you're out of the money, you will pay lower premium. You're at the money, then of course it's going to be somewhere in between the two. Okay, so the strike price at which you wish to trade, the price at which you wish to trade will inform you how much money you may need by way of premium to trade at that price, depending on whether you're in the money, at the money, or out of the money. The other thing is time until expiration. So I'll just take a quick margin money. Somebody's asking, is it interest free against securities pledged? So this is not like securities. You're not pledging any securities here. You're just buying a contract. Yeah. So your money is blocked in your account. So somebody's asking about margin money. So I'll just come. Let me see some more questions. I can take them all together. When a commodity is in contango, is it bullish or bearish market signal? Yeah. So a couple of questions here, different questions. First thing I'll take is the margin. When you pay a margin money, and when you pay margin, money is blocked in your account. Okay, so it's not the money does not come to the exchange. It is just blocked there, but it is in some sort of a what we call a settlement account. The money is there, and it is blocked towards the position that you have taken. Okay, so there is nothing like an exchange taking any interest out of that. So there's no interest there. Okay, the second question somebody had, where am I? Yeah, someone said that not volume, not liquidity available in M6 options. Yeah, agreed. In some options, there's some of the strike prices you will not find any liquidity. Yeah, and also you'll have to look at the time when the commodity is coming towards expiry. You will find that is less liquid because people are normally moving out of the contract. So you will not find very liquid, depending on the when you're entering the contract. Now, one more, Mr. Amit Pujari. When a commodity is in contango, is it bullish or is it bearish? So when your commodity is in contango, what does that mean? That means a contango market is when the future price is higher than today's price. Yeah, so when the future price is higher than the current price, it's called a contango market. Now, so the point is it bullish? Well, prices are higher, but the price could be higher for many reasons. A price could be high because of time value of money. Price could be higher in the future because there might be a shortage in the future of that particular commodity anticipated by the people who are trading now. Yeah, so there are various reasons, but it can be taken as a signal that the prices are, you can't just look at one price and make up your mind as a signal that you mentioned there, with a bear or a bullish or a bearish signal. You need to look at the direction of the movement. So you'll have to track the price for a couple of days, couple of hours to figure out which direction the price is going. Someone has raised a hand, but I'll take that later. Other thing, I'll just continue a little bit more and we'll come back to questions. So time until expiration. So when I'm looking at a contract, I want to trade at a particular strike price, then we need to look at when is the contract ending. Is it expiring on 31st of December? Is it going to expire on the next week and maybe on the 10th of December? Is it expiring on next year in March 31st? So the time until expiring, how long is that time? How many days ahead are we for the expiry of the contract, will have an impact on the premiums that you're going to offer and the premiums you're going to receive. Yeah. Price volatility is again in the underlying market. What is volatility? Prices are very rapidly moving up and down. They keep very, very volatile. Volatility is about risk. The more the volatile the prices, the more risky the price. So the minute the prices are risky, then you will find that the premiums tend to go up. Yeah. So risk, you can always look at premiums from the point of view of risk. If risk is high, then you will normally expect a higher premium from the recipient, and also the one who is paying will have to pay a higher premium if it's a volatile commodity. So there's risk-free interest rates. So interest rates will have an impact. So if there is and you're anticipating a change in interest rates between today and the date of the expiry of the contract, then that interest rate change can make money more costly or make that money more cheap because of change in the interest rates. And that in turn will have an impact on how much premium you're going to offer to trade at a particular strike price. Now, in options, some of these, they've been given some names. They're called Greeks. So you might have come across something called option Greeks. So when you talk about risk-free rate of interest, we are talking about, we call it rho. Yeah, in Greek, there's something called rho. When you talk about volatility, we call it vega, and time till expiry, we call it theta. Yeah, so we have the underlying change in futures costs, we call it delta and gamma. So we have this, the logic is the same, but only thing is they've been given some, Greek names. The same situation, we call it by different names. So don't get too much involved at this stage on that. So devolvement of options on futures, I just want to talk about this because it's important that you understand that the contracts that we have on MCX, yeah, or in India, they are all options on futures. The name of the contract is options on futures. So just to give you an idea what the options of futures are. So suppose I have an options contract, a futures contract, which is expiring on the 3rd of February, 2023. Yeah, this is today. This is today. Okay. And the contract is going to expire on the 3rd of February. There is a parallel options contract. So we call it options on futures contract. So you can trade on this options contract. You can trade on at a particular strike price on that contract. Now, this options on futures contract, yeah, it has an expiry of 25th of January, 2023. So approximately 7 days prior, 7 working days prior to the 3rd of February, you will find that the options on futures contract expires. So when this expires, if your position is, you're in the money here on this particular date, then your position will devolve into a futures contract. In other words, your position will change into a futures contract at the price of the futures contract price as on 25th of December. So at that price, your position converts into a futures contract. Yeah. Once it converts into a futures contract, you still have a few days here remaining, whereby you can still square up your positions. Which positions? Futures positions, because the options contract has expired and that position has converted into futures. And once you're in the futures, you can square up your position if you wish, or you can wait right up to the end and take delivery on that contract, because all contracts are deliverable contracts. So this process of moving from a futures contract to from an options contract into a futures contract at the expiry, on the expiry date of the options contract, that is called devolvement. Yeah, we call it devolvement. So it devolves into a futures contract. There's some other things. The underlying in the near month futures contract. Yeah, so the underlying is the near month. So when I'm trading on options and futures, let me start in a different again. When I'm trading on futures contracts, the underlying is a spot price. So when I buy a spot market contract, I'm trying to figure out what might be the spot price on the 3rd of February. Okay, so the buyers and sellers of the futures contract are punching prices that they expect to see as a spot price on the 3rd of February. Okay, whereas here on an options contract, because it's options and futures, and the options contract devolves into a futures contract, the underlying for trading an options contract is not the spot price, but it is the futures price. That is what it mentions here. The underlying in near month futures contract. It devolves directly into futures. Delivery of physical commodity on expiry of futures. You will not get delivery on the 23rd or 25th of January, sorry. You will get delivery on the after the 3rd of February. Okay. So delivery of physical commodities only on expiry of futures contract, and exercise of options will depend on whether you're in the money, out of the money, as on the date of the expiry of the options contract. Can options be sold end of day? Somebody's asked. Well, when you say options, can it be sold? What you basically, in our language, in the commodity trade, we call it, can you square up your position? That's what it means. Yeah. So when you in an OTC market, that is when you're trading over the counter with two people sitting across, you negotiate an options contract, then you can ask somebody else to step into your position and you can walk away. You can perhaps use the word, I sold my position to somebody else. But here, when you trade on options contracts on an exchange, what you need to do is you need to the strike price at which you originally traded, you trade at the same strike price and you take an opposite position. So for example, if I bought a call option, yeah, at a strike price of 50, then I can buy I can sell a call option at the strike price of 50. Okay, so that the same strike price, I take an opposite position. Yeah, so of course, whether I make the money or not will depend on the strike price at which I originally traded, and the difference between the two strike price will let me know whether I'm in the money or out of the, whether I've made money or not. Yeah, so that is how you look at this particular positions. So there is, in commodity options, we do have something called CTM positions and ATM positions. The CTM is slowly getting out of the hand. We're moving out of that, but you need to know. For example, I just go through one or two of them to make you understand what is happening. So suppose on the date when the contract expires, that means on the expiry date, the price, the underlying price, that means the futures price is 4710. Okay, What is this 4710? 4710, let's assume, is the price of the futures contract on the date of expiry, 4710. Now, what we do is we take this 4710 to the nearest 100. So it becomes 4700. So 4700 becomes at the money. Now, if on the date when the contract expired, the futures price on that particular date was 4730. If it is 4730, then the ATM would be 4750. Yeah, so nearest, in this particular case, sorry, the interval, the strike price interval is 50. So the nearest 50 to 4730 is 4750. So 4750 becomes at the money. Okay, so these are the various strike prices at which somebody might have traded. Okay, so you might have got a call at this price or a put at this price, or you might be a buyer of a call, seller of a call, buyer of a put, seller of a put. You could have picked up any of these strike prices and you might have traded at it. But on the day when the contract expires, if you happen to be trading on a particular price and the ATM has been determined the way I just told you, to the nearest 50, yeah, to the nearest 50, and then you know exactly whether you're close to the money or you're in the money or out of the money. Okay, so if you are trading at 4850, you're out of the money. If you are 4800, you're out of the money in these two positions, but you're close to the money. Yeah, so there are this concept of close to the money and totally out of the money and totally in the money. So these two positions here, they're actually in the money, but they're close to the money, closer to ATM. Yeah, at the money. So options on commodity futures, the underlying commodity futures contracts are, that is underlying is a futures contract, like I just mentioned. The underlying for the options contract is the futures contract. That's the point it is referring to here. Settlement method on exercise, options positions shall devolve into underlying futures positions. Trading hours correspond to the futures contract, which means that we trade from 9 a.m. to 11:30 or 11:55 p.m. at night. Daily settlement, options premium settlements on T+1. That means your premiums are settled at T+1. If somebody has bought the right to buy or bought the right to sell, that premium moves from the buyer to the seller at T+1. If I have traded today, then tomorrow morning you get their premium. The final settlement on exercise, options position devolved into the futures position. Somebody has got a question. What is CTM? CTM is close to money. Yeah, so I'll come back to. Someone said, what is CTM? So this is the price. ATM, you determine the ATM. Let's take a different example here, so it becomes those others who are watching won't get too bored. So I'm looking, this one is from the put option point of view. 4730 is the price, is what we call the futures price on the date. 4730 happens to be the price on this day, the futures price on the day when the options contract has finished. The price of the futures contract at that point in time is 4730. So we take this 4730 to the nearest 50, which is 4750, nearest 50. So that becomes ATM. And two strike prices above and two strike prices below are considered close to the ATM. Yeah, they're very close to the ATM. So that is what we call CTM, close to ATM, close to money. And either you're in the money or out of the money, depending on whether it's a call position or a put position. Is exactly opposite of that. I hope that answers your position, the question that somebody asked. So when your positions devolve, whenever your positions devolve, long call. What is long call? The one who bought the right to buy. Yeah, is a long call. His position, once it converts, it becomes long in futures, like buy position in futures. Long put, a right to sell. So he's basically a short seller. So his position becomes short in futures. Short calls become short in futures. Short puts become long in futures. So these are the four situations. After devolvement, if you exercise, if you have not squared up your position, if you're in the money, then your positions devolve in this. This is the nature of devolvement that takes place. So I'll take questions now if you have any. and we'll take the next. I just yeah. So if there are any questions anybody has.
Friends, if you have any questions, then we can you can share it in the chat, and then we can take it up. Mohinder, have you got any questions on YouTube?
No, sir, we don't have any questions on YouTube.
So there were some questions in the chat which I've taken up. I see that somebody else has asked. Commodity market is all about charts, and I use only head and shoulders and reverse head and shoulders. If anyone identity this you can earn. Well, commodity markets is all about charts is not right. You can use charts as a tool to trade. Yeah, so it's not about charts only. You need to understand the commodity fundamentals a bit to understand what moves the price. So just charts can help you to identify the entry and exit points. Yeah, so that's about it. But if you have a solid grounding of the commodity in which you trade, then you will be able to trade better, because you will be able to interpret the information that you get about a commodity, and you'll be able to interpret and be able to position yourself better if you have a little bit of knowledge on that commodity. So are there any difference between stock options and commodity options? So stock options are generally offered by companies. Yeah, companies give you shares to the employees by way of stock options. Okay, so they do it basically as an HR tool to, you say, if you work for this company every year, you'll get some shares in the company. So basically it is a HR tool used by corporates to make you work in the company longer. And they say that if you work for our company for 5 years, then at the end of the 5th year, we will give you 10,000 shares as stock options, which you can eventually sell in the open market. Commodity options are different. In commodity options, we are talking about the instrument options. Yeah, stock options is about, I'm giving you the shares, but they'll come into your name at a point in time in the future after you've worked in a company, for example. Commodity options are financial instrument. Instrument is options instrument. So you can trade in a commodity options. You can buy a contract, options contract. Anybody can buy an options contract or sell a contract, options contract. You cannot buy an options contract unless somebody is willing to be on the other side and agree to sell the contract on the other side. So every buyer of a call option will have a writer of a call option. Every buyer of a put option will necessarily have a writer of a put option. Yeah. So there's a trading that is taking place in that, whereas stock options are just given away by the company for services in the future. Any more questions? Any more questions, anybody?
I think we just got one.
I'm not able to see that question.
It says stock option, we analyze by support and resistance. Does commodity options are all driven in the same manner? If now, then how they gain or lose?
Oh, I see. Okay, you're talking about options on the stock market. Is that what you mean by stock options there? Okay, fine.
Yeah.
I think he means the FNO segment of the stock markets. Okay. Yeah, so we analyze them by support and resistance. Yeah, you can do the same here. Yeah, but I'll tell you one thing. In commodities, you need a little bit more depth to the commodity. You need more knowledge on commodities. Yeah, but yes, you can use the same tool, because after all, both are instruments, both are derivative instruments. Yeah, the underlyings are different. In one case, it's a stock of a company. In the other case, it is a much broader, wider commodity. Yeah, so basically, there's slight difference there. When you're looking at trying to judge the value of a company, then there are so many other factors they're looking at. Similarly, when you do a commodity, you need to know where the commodity is coming from. Is it imported commodity? Is it an Indian commodity? What the price of exchange rate? What is happening? What impact is going to have? You're looking at where it is getting produced, how much is getting produced, what are the rules regarding import in the country, and so on. So there are many things that you look at. Can you tell me something in relation to commodity and currency? Yeah, sure. So let me tell you about commodity and currency. Like I said earlier at the start, almost 85% of commodities which are traded, their prices are discovered in international markets. So you might have seen crude oil prices or the base metal prices like zinc, lead, tin, copper, aluminium, nickel. These are base metals, or gold and silver, or crude oil, natural gas. Yeah, these even in agriculture commodity, cotton. Yeah, soya, soya oil. What is crude palm oil? These are all international commodities. In other words, their prices are discovered in international markets in dollars. Okay, and how? So anytime there's a change in the exchange rate, it has an impact on commodity prices. Okay. Now, just want to tell you, when you talk about exchange rate change, you should start looking at it from the point of view of the dollar. Is the dollar becoming stronger, or if the dollar is becoming weaker? Now, if the dollar becomes strong, then the commodity prices, doesn't matter which commodity prices tend to become weak, or tend to fall if the dollar's purchasing power increases, assuming other things are normal. Yeah, that means there's no shortage or something like that. So just plain and pure currency dollar becomes stronger. In other words, the purchasing power of the dollar increases. That means you can buy more. Yeah, you'll have to pay more to buy the dollar. The dollar has become strong. Instead of paying 81 rupees, you end up paying 85 rupees to buy a dollar. The dollar has become strong. The minute the dollar becomes strong, then commodity prices in dollar terms has a tendency to weaken. Okay, so that's a relationship, what we call an inverse correlation. Dollar strong, commodity prices weak. Dollar becomes weak, commodity prices go up. Yeah, inverse correlation. So you'll have to do that. Normally what happens is when dollar becomes strong or weak, the government or the RBI sometimes reacts to it. And then they try to maintain the same kind of parity. They try to they try and bring in a parity of the same what was earlier there. So they might also fiddle around with interest rates to make the rupee strong if it has weakened, or make the rupee weak if it has strengthened. So that kind of thing is always happening. But then what it does is it creates everything. There is a time lag for everything, and it causes the prices of commodities to move, in a violent manner because of the changes brought about in the currency and the play on the interest rates. So that causes people to trade more, because people don't like a stagnant market. People want markets to be a little, they want markets to be moving all the time, whichever direction. Because the minute you have prices moving up or down, it gives opportunities to make try and make some money. So investors love it. Hedgers, does matter to them, whichever direction the price goes, they are locked into the price, so it doesn't matter to them. So this is what happens. So if a dollar becomes strong, will crude also become weak? In dollar terms, yes. In fact, one of the reasons why interest rates are going up, and this some people are saying that of course there's inflation in the US, and they're saying that to control the inflation, they're increasing the interest rates. But when you increase the interest rates, then what happens is crude oil prices come down. Yeah, there's a pressure on crude oil prices to come down, and you've seen that happening right now. And why would you want crude oil prices to go down? Well, because some country is trying to fund a war on sale of crude oil, and you're trying to make it difficult for them. So there's a lot of politics also comes into the play. Any more questions, anybody?
Okay, I think we can call it a day, Mr. Srikanth.
Yeah, sure.
Okay. So friends, thank you all for joining. Just a couple of things before we leave. If you're new to Tradeplus, then I would really encourage you to visit our YouTube channel and our socials, and you'll find more interesting information about trading, about the stock market, and about Tradeplus and its products as well. If you are already a customer with Tradeplus, then would like to remind you that we have a fantastic refer a friend program. If you are not aware of that, then you would probably want to visit the website and take a look at this. At this point of time, maybe we can also show you a video about the same.
Okay.
Yeah, here's the refer a friend video. Thank you for that video, Mohinder. Also, everybody keep updated with all the news happening at Tradeplus. We have some exciting offers coming up in December, so that will reach your inboxes and your phones very soon. See you all at the next webinar on December 16th, where Mr. Shrikant will take us to another level in commodity markets and commodity options. Thank you all for joining us. Have a wonderful evening and see you at the next webinar. Thank you.
Thank you, everybody. Thank you.